Okay, guys, back to Ask Scruff. Now, this one is for Smiler. Little salute to you, my kid. Happiest kid on the planet, him. And it's always a pleasure to speak. So, it's quite a long question, but the crux of it, without reading it all out, is why do you use a fixed position size as opposed to a variable? Been on and off trading between two ways, looking at position size, can't seem to get my head around it, and my help is appreciated. I'm always happy to help you, kid. Always happy. I tried to look into many places, but couldn't fully understand. First, fixed position size based on $1 per thousand. Yeah. Second, flexible stop loss, etc., etc. As using a fixed size constantly, you're using $5 a pip most of the time. Trading different pair with different range ATR. Okay, right. I'll let you all read this. There is method in the madness, and a lot of what I do, people do think is madness. But what you got to remember is most of what you see on the land of sort of make believe, or what you call Instagram and everything on YouTube, most of it's just bollocks, absolute crap. It's not real world trading. I've done this a long time now, and I used to follow the same path of RR. You know, you put on one unit to get two and all of this. And I come from a business background, so I know that's just a load of crap. That's just, it's an excellent sales pitch to get you involved. And what it means is, well, you basically shit at your job, but we're going to pay you because you've only got to win 4 times out of 10. The part of it, what they don't tell you is position size must be the same, stop must be the same, and the conditions must be the same. Very rarely they all add up. Now, this comes down to your position size as well. Now, I work on what's called ROI all the time, return on investment. So I'm not necessarily looking at the position size. I'm not looking at percentage of account or anything like that. I'm looking at physical money. So if I'm going to put X amount into the market, I want it to generate X amount back. Now, that might be 10% of what I've put in. It might be 110% of what I put in. It depends on the trade, because every trade is different. But then you need constants that you can work out that are easy to recognize, but also that you can do a quick math adjustment in your head and understand it. Now, if you're doing mathematical gymnastics, I put 1% of my account on and it stops down here, and the amount of pips is this, so I divide it by that, and then and my head explodes, right? So, how do I avoid margin calls? How do I keep the position size correct? One thing, another. Well, it's well documented how big my position is, my account size is. You see it every day in the Vanguard, right? So for me to go in at £5 a point is very, very small in relation to the amount of money that I'm trading. I can go up to 2.5 lots, £25, and it doesn't affect the account that much. If I have a bad day, yeah, I'm not going to be too happy about it, and 5% might get wiped out, but tomorrow I might make 10%. So that doesn't bother me. And again, you see that in the statements that I share. Now, the mantra that I came to was this: up to about 15 grand's worth of liquid money. So that's either your personal money in your account or the drawdown on a prop fund. Now, prop fund is slightly different because you'll always have people sizing to the account size. Well, that's stupid because that's just buying power. You size to the drawdown. That's the liquid money. And if you go £1 or $1 for every 1,000, what that means is you've got enough margin to open up the asset. Because if you go on to the DAX, for argument's sake, you know, it can cost you 500 quid or 400 and something just to open up a pound position. But then you need the margin requirement as well to allow movement. So whatever the margin is to open up, you want double that in your account. So if I'm opening up £1 a position, at 500 quid to allow for the margin, that needs to be 1,000, right? The numbers are just off the top of my head. You can look at any chart and you can see what the margin is. So if you look at something like, I don't know, what is it? Give us a second. I'll tell you. So pounder point on the DAX is, well, it costs you 1,100 on the DAX. So you need a £2,000 account, near enough for £1. So if you haven't got 2,000 in your account, you're probably struggling trading the DAX. Let's have a look, see what £1 would cost on, say, the FTSE, because the FTSE's a cheaper market. Okay, or at least it will be when I open it up. Give us a sec. Deal. Cost you 431 margin on the FTSE. So you could trade the FTSE with £1,000 because that's like 800 quid. All right. So what that does for me, excuse me, is I know instantly that if I'm on a pounder point, 1,000 quid, I can easily open up that account and not get a margin call. So that's the beauty of fixed. Now, also what it means is I also know what the ROI is on it. Every 10 points, if I've got £1 in, I'm getting 10 quid back. Very quick, ready reckoner in my head. Now, again, when I've got a fixed position, I know where the stop is. If that stop is 50 pips away, I know straight away that costs me 50 quid because it's £1 for every one. So I have to ask myself the question, do I want to pay £50 against this trade? And the answer will be binary. It'll either be yes or no. If it's yes, then fine. It's going to cost 50 quid. I've agreed to it. And I know what my account balance is. And 50 quid against it, I can visualize it. It's not like trying to go, well, what's 0.5%? And then work it out. What's 50 quid against 1,000? Well, I'm left with 950. I'm not going to be happy about it, but it's not going to kill it. All right. But you might consider that to be too expensive. So if you've said no, I'm not willing to do that, again, you're in a binary situation. Is it a good trade? Yes or no? Well, yes, but I don't want to pay the cost. Half your position size. So you're now going in at 50 pence, right? Which means that trade, if you're wrong, it's going to cost you 25 quid. So, and if it moves 10 pips for you, you're going to get a fiver back, right? So what it does for you is it immediately helps you look at the chart in a very simplistic manner. You know, this is how much it costs. Right, I've got a £5,000 account. Cool. That means I've got a maximum of £5 I can play with. Fiver. Right. How far is the stop loss? Well, it's X points, like we've just said. You can quickly see how much it costs. And then you can decide whether you're going to put your whole fiver in or whether you're going to cut it in half or break it up using madness to reduce the exposure. Fixed positions do this for you. They give you the maneuverability that you can ask yourself questions and work the maths out like that. And you're also working with money values, so it becomes real. And that's the big thing for me. I want something that's tangible. I want something I can touch and I can feel. I can't feel a percentage. It doesn't mean anything to me. But if you say you're taking 500 quid off me, that means something to me. I know exactly what that means. And fixed position sizes do that for me. So I hope that helps you in a strange way. When it comes to variable, they've just done my head in. But that's my version of it. So up to about 15,000, I work on £1,000. Once I go above 15, 20,000 in your account, you then half it down and you'll go 50p for every 1,000 thereafter and then size it down again. because the one thing you never want to do is overload the account. So I trade relatively small in relation to the size of the account. That way, I've got room to breathe. I'm always trading at peace, because if it goes wrong, well, I've already agreed to it and no one can afford it. And I never worry about a margin call. And if you look at the Vanguard series, see, I mean, that's over 5,000 quid now in the last 6 weeks from 200. And I was trading at 10 pence, 10 and 20p's. And I finally got it up to just say a quid, you know. Happy days, happy days. So that's my theory behind it. Hope that helps you, Smiler. Catch you soon.